Good afternoon, and thanks for joining us for today's webinar, the what, why, and how of quality of earnings. Exciting stuff. You can't wait to get started here. So let's go right into introductions here. My name is David Blain. I'm a partner here at McKonly Asbury, and I'm the Director of Entrepreneurial Services and Transaction Support. My experience has been on the transaction advisory side. I've done a number of transaction activities during my time here at McKonly Asbury. And joining me is none other than the great T. Eric Blocher. Eric, why don't you tell us what the T is in T. Eric Blocher?
Well, Dave, I could tell you that, but then I'd have to eliminate you. It's a secret. Thank you, Dave. Yeah, like Dave said, my name is T. Eric Blocher, otherwise known as Eric. I'm a partner with the firm. I'm also the Director of Valuation Services, and my expertise is on the valuation and business support expertise. I've been doing valuations for our clients for almost 27 years for estate planning, gifting, transactions, litigation support, and a bunch of other purposes.
Excellent. So let's go into firm overview. I think, Eric, you're going to give us a little firm overview of McKonly Asbury.
Yes, I certainly will. As it says, McKonly Asbury, we're a team of CPAs and business advisors. We serve clients from 3 offices that we have in Camp Hill, Lancaster, and Bloomsburg. We provide advisory and business consulting services, audit and assurance services, entrepreneurial service or support and client accounting, internal audit, professional placement, tax services to a variety of industries. And when we say variety, we mean a variety, an awful lot. Affordable housing, construction, employee benefit plans, family-owned businesses, healthcare, manufacturing, distribution, nonprofits. And that's really just the tip of the iceberg, but that's some of our primary services and industries that we help.
Absolutely. Absolutely. So talk about CPE, Eric. You want to give everybody the lowdown on CPE and
absolutely. If you're an accountant or you need CPE, this is a great source for it. And I know that getting those hours is important. So if you need CPE, thing to know is you must answer all 3 polling questions throughout today's webinar. We will email CPE certificates out within 2 weeks after the presentation. You will probably have a survey to take afterwards for rating the class as well. And if you have any questions during the webinar, please submit them through the built-in questions function at the webinar control panel, and we will try to address them as we go along.
Okay. I guess the key here is make sure of the 3, make sure if you want 1 CPE credit for today, because it does qualify, you answer all 3 polling questions. Otherwise, we can't give you credit. So you need to answer all 3 polling questions. And Eric might have some bonus polling questions for everybody that will not qualify for CPE, but there might be some bonus polling questions that are floating out there as we go along here. So, all right.
There are no wrong answers to the questions.
Yeah, there you go. All right, so today, just to kind of give everybody the agenda for today, basically this is going to be an overview, high-level overview of what a quality of earnings is. It's a big topic out there in the transaction world. It's a term that's been used. It's being used a lot more prevalently in the marketplace. So we want to talk a little bit about what a quality of earnings or a QofE is. So we're going to talk about we're basically be like Inspector Clouseau here. So we're going to talk about what is a QofE, why do we perform them, or why are they performed, who should have a QofE performed, when should you do one, and how is it performed ultimately. So we're going to go through the who, what, where, when, and whys of the quality of earnings process. So without further ado, let's start with the what. Let's start with what is a quality of earnings. In its simplest terms, when we talk about quality of earnings, it's in a transaction, it's all about trying to verify the legitimacy of the cash flow stream or the income stream of an organization. You can a lot of times in a valuation perspective, Eric does a lot of valuation work. we look at the cash flow stream and the income stream to come up with a value in the business. However, we don't go dig into the depths of, what are the components that make up that value, that cash flow stream or that income stream, and what is, how are those components working, almost like performing procedures around those numbers. So what a quality of earnings does is, in its simplest form, is you're really trying to verify the cash flow stream and the income stream.
Yeah, and it's not what
determines. What was that again, Eric?
It's not really what you would think of. When I was preparing for this webinar, I thought back to my grandfather, who was a public accountant for over 50 years in the industry, and he never dealt with quality of earnings. And I thought to myself, what would he think, about quality of earnings? And I made myself laugh a little bit, because I'm sure he would look at a number and say, oh, that's some quality earnings right there that they have, and add another zero, it would be even more quality of earnings. And that's really not what the process is. So it's different than what you might think when you first hear quality of earnings, and think it's just a number.
Yeah, absolutely. I mean, what we're going to find out here is, when we talk about quality of earnings, and it's really a test of the cash flow stream. We're going to test the cash flow stream from the perspective of certain procedures that will be tested over cash flow, looking at analytics to ensure that the items that are within that cash flow stream are within standards or within maybe some type of industry expectation. And then we'll look at other analytics as well.
Yeah, and every quality of earnings engagement can be different. Every client's different. The depth that we are expected or desired to delve into can change in each engagement too. So some of the things that we'll talk about here that you typically do and look for, that can just be the beginning of a quality of earnings engagement. Yeah,
absolutely, Eric. So, typically when we talk about QofE too, in a quality of earnings, it's typically, you're looking at a trailing 12-month period. What has happened over that trailing 12 months? Could you look at other periods? Sure, you could look at maybe a calendar year period, maybe the last couple of years of periods. But in most quality of earnings projects, you're looking at the trailing 12 months, and because that's really the most consistent or most earliest cash flow stream of items that are there for you to really kind of get a feel around what's happening with that organization. And typically, when we look at it, the term that's used the most and what you're looking at the most is really EBITDA, and that's earnings before interest, taxes, depreciation, and amortization. Now, in a valuation world, when we're looking at valuations and we talk about cash flow, we're talking about other items. We're talking about EBITDA, but then we're also talking about some other adjustments that may impact EBITDA, to get to cash flow. But for the most part, when we talk about EBITDA, for most businesses, EBITDA is really recognized as the cash flow stream for a business more than anything. So when we're looking at the trailing 12 months, we're really looking at that. We're really looking at what's happening with earnings before interest, taxes, and amortization.
Yeah, and like Dave said, EBITDA is a proxy for cash flow. Now, in certain instances, it might be smart to expand the quality of earnings beyond a 12-month period. An example of that would be if earnings or EBITDA was increased dramatically over the previous period. You might want to expand your procedures to find out why and to see if that expansion is, you can carry that forward. I know with just having done a lot of valuation work through the COVID period, COVID pandemic, that there were some industries that had a surge in revenue and profitability due to COVID restrictions. Now, if that's changed, you might want to go back and look previously, like beyond the trailing 12 months, to really get an idea of what's sustainable on a go-forward basis. So there are instances where you might want to expand beyond just the typical 12-month period, but that would vary on a case-by-case basis.
Yeah, absolutely. The other thing we should talk about when we talk about quality of earnings too is that it's not an audit. So a lot of you might be thinking to yourself, well, can I get, if the company's audited, can't that really give me a good feel for the quality of the earnings of the business? And absolutely. I mean, a company that's under audit, that you have an audit report with an unmodified opinion, clearly is going to give you comfort. What this process does, though, is it really hones in on certain areas in the cash flow stream to really give you verification that it's generating the income or the cash flow out of that area that you one might think. So while it's not an audit report, you're not going to have an issued audit report. It's more of a consulting report, where that consulting report is going to outline in specifics the areas that you're really going to spend the majority of your time looking at, maybe additional testing, maybe looking at contracts, could be a number of different scenarios, deeper analytics on certain areas to look and compare to industry data. It could be a number of different things in that quality of earnings area, but keep in mind, it's not an audit. It is an actual consulting report that is being delivered that is focused in on certain specific areas of the organization that you're looking at.
I agree with you 100% there, Dave. Like you said, an audit can be an area, if they have an audit report, that can be something that reduces the overall risk, and that can come up because it is a financial statement that procedures have been applied to, versus if you just have a tax return prepared or internal financial statements. You really don't know the accounting policies and procedures that were followed there. So to predict what's going to happen in the future based on something you don't know how they're handling, it makes it a little bit harder.
Yeah. So I think that kind of covers the what makes up a Q&E. Let's talk about why you perform quality of earnings assessments. So, QofEs are performed in order to establish a basis in the purchase price through the review of the cash flow and the income. So similar to what you would see in a valuation, in a valuation of sorts. You get a valuation on your business or your company, and typically a lot of times, if it's for the purposes of positioning the business to sell, you're using that valuation report to help you determine what is the real value of that business. The thing about a QofE, though, is it's going to allow you to look at the true operations and what a buyer might be looking at, or if it's a seller, what the seller might be, as a seller, what are some of the things and areas that you could be doing to improving your cash flow process. So when you talk about QofE, it provides investors with a basis for determining that value, establishing a normalized cash flow stream over the last 12 months or a 24-month period, or whatever period that you're looking at. But that's really what we're trying to do here, is to come up with, what is that cash flow stream? What does it look like normalized? What are the key components of the cash flow stream that are of most significant value? And then let's do some testing around those areas to see for sure whether those components are consistent, legitimate components of the cash flow stream and really driving its value.
Yeah, Dave, when you see something come to market and you have the historical EBITDA and cash flow stream, then they'll have the adjustments that they might be saying are appropriate. Quality of earnings engagement will go back and review those adjustments to see if they are indeed appropriate or in the correct amount, or if there are additional adjustments that might need to be made, and then look at other items, such as risk that won't even show up in there, but riskiness of revenues and other things that we'll talk a little bit more about later, enters into a quality of earnings report.
Right. Okay. Again, when we talk about the why perform one, it's going to obviously help you establish market multiples on a deal. It's going to help you identify what is that what does that trailing 12-month EBITDA look like normalized, and how is that going to impact the market price or a market multiple? If you're a publicly traded company or an actively traded stock, obviously you want to look at the idea, is the stock accretive, or is it going to be, or is the value going to be accretive, or is it going to be dilutive to your stock? Clearly, you don't want a dilutive answer is not a good answer. You want something that's going to be accretive. So if you're looking at a deal where the quality of earnings is showing a lower market multiple, well then, or showing a lower value, that might dictate the purchase price and how you want to go about structuring that deal. Helps in determining financing and overall deal structure for return on investment. It helps with the established EBITDA levels for earnout provisions, and can identify poor internal accounting or lack of controls. And that's something that we can talk a little bit more about, because a lot of times when we talk about quality of earnings, we talk about it from the perspective of what is, what is the buyer looking at. But, quality of earnings reports can be done by a seller too, and that seller can be utilizing that information for not only structuring a confidential memorandum, but it might be better. It might be used by them to help them better assess their internal controls and test their internal accounting policies in what will drive value to the organization.
I agree with you, Dave. When I'm doing valuations, a lot of things that clients and business owners want to know is, what can I do to improve the value of my company? And having a quality of earnings analysis done, you can help that, because one thing to think about is a buyer is always going to, or most likely a buyer is going to insist on having a quality of earnings done. If a seller has one done ahead of time, one, it saves on the time for a transaction to happen. Two, it can point out maybe some things that could be fixed that could improve the likelihood or the selling price of your company. Things that come up in a quality of earnings analysis, you have time to fix it then too. So typically when I'm doing evaluations for owners that are looking to transition out of the business, I tell them that it's good to get in early in the process and to have things done, because you still have time to correct them. And that's one of the reasons why a seller might want to have a quality of earnings analysis performed, is because it identifies the issues and can still give them time to make some changes and to address them going forward for when they actually want to get taken to market.
Yeah, good point, Eric. Well, a question just came in. The question is it a quality of earnings an agreed upon procedure? I mean, it could be. It really could be. I mean, a lot of times it's a consulting report that's issued because you're hiring a firm that has experience in this area that's going to be able to, with some guidance on what you'd like to see, go in and do some work around the cash flow stream and the income stream. However, if there are specific items that you're looking at that you want to get better verification on, it could be an agreed upon procedures engagement where you go and hire an accounting firm per se to say, hey, listen, I want you to focus in on this revenue line, or I want you to focus in on these certain areas, and you have an agreed upon procedure engagement. But in most parts, I see it as I've seen more on the side of consulting engagements where you're hiring the firm because that's what the firm's good at. The firm's good at doing quality of earnings studies and going in and assessing where the risk is and where the areas that of most concern, or the areas that you want to really dig into and delve into deeper are at. And then that's where that firm's going to go in and do the work around what needs to be done there to kind of give you that comfort that the cash flow stream is what has been presented to you.
Yeah, exactly. Now, Dave, also, if you're doing an agreed upon procedures engagement, the procedures identified are the only procedures that you should be doing.
Exactly right.
A consulting engagement for a quality of earnings, you have a broad range of procedures that you could do, and you might not even know going into it that you're going to do them until you start digging deeper. Yeah. For example, if you look at it and you compare 12 months and the receivable balance is going way up, you might want to dig into the aging of the receivables in more depth to see if there's some that you might not be received, and should they have been written off. But you don't know what you're going to do until you start digging in to some of these things. And that's why I think it's more effective as a consulting engagement versus an agreed upon procedures engagement.
Right. So let's go to the first polling question. It's what is your knowledge of the quality of earnings process? So we'll give everybody about 60 seconds to answer this first polling question. And in the meantime, Eric, you have an alternative polling question, I believe, that you're going to throw out there.
Yes, I do. Anyone that's been on a webinar that I've done before, I like to have entertaining polling questions. So I had some prepared, but we wanted to get some information on our attendees, so we asked these, but I'm still going to ask the other ones that I was going to put out there. And keep in mind, there's no wrong answer. But I had a picture of a hockey player, and I said, name this hockey player. It was from the iconic movie from 1977, Slapshot. And I said, which one of these is it? And it listed 3 people, 2 of which were in Slapshot. So the first one, was it Ron Hextall, was it Reggie Dunlop, or was it Ogie Oglethorpe? So you guys can figure out which one of those was not in Slapshot, which is one of David Meyer's favorite movies.
So we'll let everybody chew on that for a little bit as our polling questions come back. So you know, we got a wide variety of information here. We got 24%. I know nothing. I used I know nothing from Hogan's Heroes. So I have heard of the quality of earnings process, 41%. I have limited knowledge, 30, and our business is using the process, 5%. So good. That's good. That's kind of a good cross section of information there of the people that are on the call. So hopefully this is going to be some good information as we keep moving forward here. All right, let's keep moving ahead here. Next item is we're going to talk about the who should perform a quality of earnings. Go right into here. So, you know, when we talk about this, you know, first thing is, you know, the term quality of earnings, it's become more common in business transactions over the last 10 years. When I remember back in the mid 2000s, I would do transaction activity. It was always, can you help us with a due diligence? Can you help us with making an assessment of some type of a revenue line or a revenue stream? And, you know, answer would always be sure. As it has evolved over time, the words quality of earnings have now creeped in there in regards to really helping businesses assess what that revenue stream and what that cash flow stream looks like, and what the quality of it is in regards. So when companies buy, they're buying more of a packaged product, I guess you could say, that's going to start to generate cash flow right away, or at least help them understand what that cash flow is going to look like, so they can better finance it, better structure the deal and the deal structure itself. Often QofE is requested as part of a transaction by the acquirer, as it gives its management investors comfort over the income and cash flow stream and the accounting related internal controls as discussed. So we talked a little bit about that already, that in most instances, if it's the acquirer is usually the one that's asking for the quality of earnings study. Usually what will happen there is they'll come to an agreement on a transaction with the seller, and then they will retain a firm, or maybe they do it in-house, where they go in and they'll do this quality of earnings study to determine what is normalized the EBITDA and cash flow of that business, and what is the quality of that revenue stream or that income stream that is generating the EBITDA for the business.
Yeah. Now, Dave, to put this into a little bit of perspective, you know, if someone gets some financial information on a target business and they know generally the sales revenue, cost of goods sold, the bottom line, you know, EBITDA, but they don't know what is in it, you know, and I would argue that, you know, a company that has one customer, you know, that results in all of their revenue, and they don't have a long-term contract, is different than a company earning the exact same revenue from 100 different customers, and, you know, that have, you know, year-long contracts in place. There's risk associated with companies beyond just the numbers, and that's what quality of earnings, or that's some of the things that a quality of earnings, you know, is looking at. If you have, you know, a sales force and 90% of your sales is derived from one salesperson, and that salesperson doesn't have, you know, a contract, long-term contract with the company, there's risk there with, you know, the earnings stream, you know, versus another company that has 10 salespeople and they all contribute equally. There's less risk with them losing one of those salespeople than there is with the one person. And those are items like that will show up in a quality of earnings engagement.
Right. Absolutely, Eric. So, you know, in today's environment right now, you know, it's a very acquisitive environment from the perspective of transactions that are happening in the marketplace right now. 2022 was a big year in the market when it came to transaction and deal volume, and 2023 is kind of setting up to be similar to that as well. You know, so when you talk about, you know, who are some of the who are some of those that are performing these quality of earnings reports? Well, on the acquirer side, clearly private equity firms. There's a lot of money in private equity right now. Private equity is looking to try to find organizations that are out there that would fit into their investment portfolio and immediately turn cash flow and dividends for their business or for their investment model. So private equity firms are very active in this market as acquirers. And then you also have these acquisitive market buyers, a lot of businesses that are out there that are seeing the value and the opportunity of going out and acquiring their competitor or acquiring businesses that maybe are ancillary to their business, provide some upside to their organization, maybe provide a specific product line that can really layer in nicely on their business. So you see a lot of that in the marketplace as well, as businesses in general are pretty solid in their cash positions, and they're looking to utilize that cash to acquire. So they're the two biggest ones that you see right now in the market right now that are driving transaction volume. And then there's other capital markets or interested buyers that are out there as well. They're outside of private equity or acquisitive market buyers. And then basically completed for all the reasons discussed above is what you see out from an acquirer perspective.
And Dave, aren't you seeing, there are even some lenders that are encouraging quality of earnings to be done?
Yeah, a lot of times, and that's what I'm talking about, other capital markets are interested. What we're talking about there is a lot of times what you'll see is if the organization's going back to the third party for financing, it could be a bank for bank financing. They're looking to try to do a deal. A lot of times now these banks are asking for a quality of earnings report for them to use internally with their with their underwriters, to be able to give to the underwriters that this is the assessed value of this cash flow stream, and this is the quality of that cash flow stream, because they're looking at the idea that we need to be able to get backside protection, that the loan that we're going to be going out for here is going to be, they're going to be able to pay it back, and they're going to be able to pay it back with that cash flow stream. And then the other thing too is a lot of times these lenders are also utilizing that report to help structure the loan deal in regards to saying, we're going to take X amount of cash out of that organization every year to pay back the loan over time, on top of maybe being some type of fixed debt. So, again, you're right, 100%, Eric. You're seeing it from a lot of other third parties as well that are asking for these types of reports outside of just private equity and acquisitive buyers.
Yeah.
So let's talk about on the other side though here, because a lot of our conversation's been around if you're a buyer, using a quality of earnings report to give you comfort over that cash flow stream. But this report's actually very valuable for a seller. And I just saw a question come in and said, if I plan to sell my business, should I do this? Well, we're going to talk about that right now. Hopefully this will answer your question. But this can actually be very valuable to a selling organization, because if before you go to market, doing a quality of earnings study before you go to market is going to give you the benefit of what the acquirer is going to be looking at. It's going to give you the benefit of the key areas of revenue streams, contracts on those revenue streams, and then also what are some of the things in your expense base that you need to normalize out that will help you better understand what the value of your the organization is. So again, the seller can do it in advance. I think it's going to assist you in positioning within the market. It can also assist with identifying problems in your cash flow stream, right, Eric? Where
exactly.
You're gonna, because it's going to really uncover some areas that you might say, hey, listen, now's not the time to go to market with our business. Let's correct these issues internally with our cash flow stream. Try to optimize that. Try to better optimize our cash flow stream so it ultimately increases the value of your business. Because the more cash flow your business is going to generate, the more likely that your market multiple is going to be higher. So you want to do that kind of stuff to try to really hone in the structure of your cash flow stream. So hopefully that answered the question that just came in. But yes, if you're a seller, this is a good opportunity for you to prepare quality of earnings. The other thing too to keep in mind too is if you do a quality of earnings study in advance. That does give you a little bit more credibility if you're going to market, because you're going to be able to, probably more likely than not, share that quality of earnings report with the seller or with the buyer. If you feel like that's a good position to do that, but you could provide that as part of it. And it could be, if you do it, if you're selling your business through a confidential memorandum type of a situation where you're going to market through a CM, having the quality of earnings report attached to it is probably not a bad idea either. But
Yeah,
yes, as a seller, you could do that.
I agree, Dave. I believe it gives credibility. There's a chance that it can shorten the transaction time, which means you get paid quicker. It also can allow you to make sure that the normalization adjustments that impact value for your side are included. Now, that being said, with a buyer and a seller, there's still certain levels of give and take. The buyer could say, "Oh, I don't believe in, I don't think this is an adjustment or not," but at least you've established your position as to why. You could have family members employed that aren't necessarily required ongoing. You could spell that out. You could address a whole myriad of issues ahead of time, get them on the radar screen of the buyer, and so at least you'll have the discussions. But shortening the time frame is another one, and having the opportunity to increase the multiple by showing greater amounts of cash flow with normalization adjustments, can be key, to a seller. And there's still an outside chance that they might rely on yours, and they might not have to do anything separate. So it could be a lot quicker.
Absolutely, and we're going to talk a little bit about who can perform these types of reports, and why having a quality organization perform the report is kind of critical. Because again, going back to what you said there, Eric, you might be able to share your report, and if it's done by a quality, reputable organization, the buyer might accept that. So let's talk about, when should a quality of earnings be performed. So most often, a quality of, if you're the buyer, or even the seller, most often the quality of earnings report is prepared once a letter of intent is signed with an organization. And typically, at least what I've seen over my times doing this, is that once that LOI is signed, there's usually some type of time period that is out there that says, okay, once the LOI is signed, we're going to complete this quality of earnings report. And in the time period of the quality of earnings report is established, maybe it's the trailing 12 months, maybe it's a situation of, we're going to look at the calendar year because you're close to the end of the calendar year. But usually there'll be a set time frame of, we want this completed within 30, 45, or 60 days. Typically what I see is usually 45 to 60 days. 30 is pretty tight, because in a quality of earnings, you're going to be putting together a items needed list. You're going to be wanting to test cash flow streams and revenue streams, and you're going to want to review normalizing adjustments and review the detail of those normalizing adjustments. So while it has the look and feel of an audit, obviously it's not an audit, but it has a lot of the same scenarios that occur there, where you have to set the appropriate time aside to really dig into the details of those areas that you're looking at.
Because if you find something, you have to have time to figure out the reasons why, and address them. And other items, a proof of cash is sometimes needed to make sure that you have all the revenue accounted for.
Yeah, and we'll talk about that in a little bit on the how, but proof of cash is definitely one of the biggest items that I like to utilize, is that cash to revenue rec, where because a lot of it's cash and the revenue and cash should be following each other. So doing that cash to revenue rec is really kind of big, but it takes time to sort through that analysis. The other thing too is, we talked about, QofE can be completed in advance by the seller before going to market as well. It can be a tool for determining matters of concern within the cash flow stream, which we already talked about. Can assist with improving the overall operations of the overall business. can be used in a confidential memorandum. We talked about, in regards to you putting together your confidential memorandum of what your business is doing, how your business operates, who your key contracts are with, and gives you that information then to kind of shore up that, our key contracts have been reviewed under this quality of earnings scenario. And overall, of all of the above items can lead to higher valuation, increased market price, kind of like what we've already talked about in the more recent slide that we just talked about earlier.
Yeah, I mean, some other items that can be highlighted in the quality of earnings. If you're the seller and you know that your company turns over or collects AR better than most anybody, turns over inventories, you could calculate and show a comparison of your turnover ratios with industries also, which is very beneficial because that can be a positive generator, cash flow and a better indicator of the quality of the earnings. And that can make for a very strong argument for possibly a higher multiple. Now, on the flip side, if you're the buyer and you find that a company is performing below all of the industry standards on some selected financial ratios, then that argument can go their way too.
Yeah, I mean, this is a good slide here from the perspective of, one of our earlier questions again talked about, if I'm selling my business, should I do this? There's a ton of value in doing this on the sell side. Think about if you can increase your market multiple by 1 over your EBITDA because you were able to do this study and it uncovered some things for you in regards to your revenue or expense streams that you were able to correct and modify so you could better address a trailing 12-month or a period of EBITDA that is under review. That could pay huge dividends for you. So finding that out in advance of the buyer and the buyer doing it, where the buyer comes back and says, hey, our quality of earnings study is telling us that there might be some issues in regards to the collectability of some of your revenue lines. Doing this in advance could create significant additional value and a significant additional cash to you at cash out or sell. You know what I mean?
Yeah. Another question came in, Dave. If a seller does a quality of earnings to have it ready ahead of the process, how often will the acquirer rely on that information? And I don't know what your experience is, but it depends upon, I think, the firm doing it, and ideally an independent, experienced firm doing a quality of earnings, and if they do it well, is much more likely to be accepted from the purchaser than someone that isn't well versed in it, or here's the quality of earnings that my internal accountant did.
Yeah, no, absolutely, Eric. I mean, that 100%. I mean, I think that if you do this in advance and it's done by a reputable firm that can demonstrate that we have a certain amount of deal volume in regards to doing QofE studies, that very well your QofE as a seller could be accepted by the buyer, because the buyer is also looking at that from the perspective of, could this increase the time period of trying to close the deal and to get the deal done? And if it's a quality of earnings report that's done by a reputable organization, that's going to be definitely helpful.
And they would save the cost too.
Yeah, we can't guarantee that it would be accepted, but there's a chance that it could be. So, all right, let's go to polling question number 2. I can't believe it's 2:38, so we got to keep moving along here, but let's talk about the second polling question. What is your reason for attending the webinar today? There's your choices. We'll give everybody about 60 seconds. And Eric, is there any alternative polling question that you have that you want to discuss?
Yes, there is. As you're reading that, this was going to be the alternative polling question. You are transported back to the 1980s and given 1 quarter. Do you A, B, or C? A, buy a pack of baseball cards. B, buy a marathon bar, which they don't make anymore. C, throw a quarter in a Pac-Man machine faster than you can say lickety-split. For me, this would have been a tough question. It would have been between B or C. I am not proud to admit that I have dumped an a large amount of quarters in video games in my time.
Were you a Pac-Man guy, Eric? Did you like your Pac-Man, or did you like your Donkey Kong?
I had all of the patterns memorized, and I was a video junkie. Yes.
You were a Donkey Kong guy, weren't you? Space Invaders.
I was Asteroids, Pac-Man, but my favorite game was an obscure one called Robotron 2084. It was a crazy game. It drove people, gave them fits, but I loved it.
All right. Well, I think the polling, we're coming close to closing the polling question here. So we'll let our producer, and let's give our producer a shout out here, Henry Coleman. He's our producer today, and he's producing this like it's The Price is Right. He's all over it, man. He's all over it. So let's look at reasons for attending. Again, pretty good assessment here. We have 33% learn what it is, 32% gain more knowledge. Assess the need to perform one is 4%, and that you gotta love that. I just gotta get my CPEs in there. Hey, listen, I'm just as guilty of that sometimes too. Like I gotta just get my CPE. So totally understand, but hopefully those that are just getting their CPE get something out of this and have something to go with. So let's move on here to the next item here. We're going to talk a little bit now about the how is the quality of earnings performed. So typically we talked a little bit about this in utilizing an organization that is that's experienced in this area. So QofE is usually performed by a qualified financial advisor. It could be a transaction firm, and that transaction firm has a QofE specialist, financial analysts that work inside of it. A valuation firm, a lot of valuation firms, quite like McKonly and Asbury, where we do valuations. We also do a lot of quality of earnings studies, and obviously CPA firms would be very, very well qualified to do this type of work. As noted above, QofE is not an audit, so again, just make sure that we're fully aware. So you're not going to get a report with an audit opinion to it, but it's more of a consulting project that focuses on specific targeted matters that are driving income and the risks of that business. And in both the income statement and the balance sheet matters are addressed. So, and we're going to talk about that in a minute here, but we've talked a lot about the income stream. We've talked a lot about the cash flow stream, but the balance sheet drives a lot of that. If you think about it, it could be the AR that's on the balance sheet. It could be driving some of the cash flow stream issues or matters. There could be other expense items of it, cost of sales. It could be WIP on a on a construction company. But looking at the balance sheet along with the income statement is still of very much importance when you're talking about a quality of earnings study.
Yeah, looking at the balance sheet can give you important ratio and turnover information, and also we'll talk more about it later. But working capital is there. Now, there's two questions that came in, Dave. One of them says, how far in advance for the quality of earnings? If one was done in August of 22, how long would you say that it's still viable to distribute? My opinion is it would depend, and I would still distribute it, because if there's something there, you could say, well, we've done this since then. It can still present a good picture, even if it's out of date or may want to be updated a little bit. So I would think it would still be a good thing.
Yeah, I think you make a really good point, Eric. I think again it comes down to if you're talking about if you did one that was on August 31st of 2022, and we're talking about being at the end of January 23, I would say that report is probably still relatively fresh. I would say once you get outside of that 6-month range, then you're talking about the report may not be as fresh as you want that report to be, and you may need to have that report updated. Very similar to evaluation, right, Eric? I mean, valuation reports, we tell people all the time that, outside of 6 months, that valuation report might not be as fresh as you want it to be, because a number of things could happen in your business. A number of things could happen in the industry. I mean, heck, a number of things could happen in the economy that could impact your business. And, so something that is outside that 6-month period may not be as fresh as you would like it to be. So I think it really depends. I can tell you this, during the COVID environment, we were looking, when we were doing quality of earnings for, we were doing a number of quality of earnings reports for a healthcare organization that we support. And what we were doing there is we were really not looking as much at the trailing 12 months inside the COVID period, but we were looking at the trailing 12 months that happened before the COVID period, because we were looking at that from the perspective of that was more of the normalized activity of that business that happened during that period, because there wasn't PPP money running through it, or employee retention credit money running through it, or any other types of government stimulus that might have been running through the business. So we were looking at stuff that was outside of that COVID period. So, there could be an example of, yes, having a quality of earnings report that was done effective 12/31 of 2019, might be one of those things that you say, well, that's not within the trailing 12 months. But again, that was a situation that was unique, and that was where it was decided from that organization that we were supporting that it might make more sense to look at that income activity and that cash flow activity that happened before COVID. But in the most instances, you want to try to keep the report fresh, probably within a 6-month time period. That is the dates that you want to use that report for.
Yeah, I would agree, Dave. Now, for valuation purposes, I typically say if they're IRS related, I like to stay within 3 months, because I've never seen the IRS question within 3 months of valuation report. But there isn't more of a chance from 3 to 6, but some attorneys will say they don't care. They're going to do it, at 6 months.
Right.
Now, the next question that we got, I think, knows the next coming slides. They asked, can you provide a list of typical things you're adjusting earnings for based on your experience? Well, the next couple of slides should answer some of your questions.
Yeah, I think so too. So, when we talk about what is reviewed, as previously mentioned, it's typically the trailing 12-month period is usually what's identified for review. Specific items that are usually identified during the review are going to be overall revenue, specific revenue streams of interest of the acquired, customer concentrations. So in other words, what we're going to be looking for there typically is doing some type of cash to revenue reconciliation, looking at the contracts that are in place and the revenue that's following those contracts. Is it consistently following what the contract might say? Performance of different business lines. Maybe it's a situation where you're acquiring a specific business line, or what you're trying to acquire is the market presence of a business line. Looking at the performance of that maybe specific business line in regards to its revenue and its contracts, its cash flow generation. Expense-based matters. Clearly, you're going to want to look at the biggest expense-based items that you would be acquiring. So clearly, payroll is one of those bigger items. If it's a manufacturer, maybe it's materials, and it's material costs that, and the material cost contracts that you have that are in place there that you would be acquiring, and other identified costs that are specific to your industry and specific to your business. And then there's discretionary expenses. Discretionary expenses being, are we extracting out anything that is, unusual expenses? Maybe, a lot of times we see businesses that have personal expenses that are running through the business, just taking out those expenses, looking at expenses that may be items that it could be things like you have a box at Citizens Bank Park for the Phillies. Maybe it's not something that the acquirer is looking to have. They're looking at those discretionary expenses and how those expenses are being handled internally.
Yes. Before we go to the next one, Dave, they had another question. They asked me what I mean by 3 months for IRS purposes. I was speaking about a time frame that I deem to be reasonable between the effective date of a business valuation that I'm doing for IRS purposes and the date of any transaction. So if I do a valuation for a gifting transaction, I recommend that it's within 3 months of the actual date of the transaction. So if I would do it effective September 30th, then they could do a transaction anytime up to December 31st within a 3-month period. And my experience is that the IRS won't challenge that and say that the valuation is stale. So I was just comparing a valuation, a time frame for whether it's relevant or not with a QofE, which in my opinion, you can push out a little further.
Sure. Let's go on the next slide here and talk about normalized results. So, again, when we're talking about quality of earnings, we're talking about what is the cash flow stream from a normalized perspective. So, normalized EBITDA perspective. Some of the things that we're going to be looking at that are typically addressed immediately that we would identify under heavy scrutiny or review are going to be one-time charges, things that may be flowing through the business one time. Maybe it's a grant of some sort. Maybe it's a one-time revenue hit. We're going to look at those things and try to extract those things out. Personal expenses, again, we talked a little bit about this. A lot of times, smaller businesses, it's just the nature of the way it is. Sometimes personal expenses might be run through the business. We're going to try to extract those out, look for what those items are. Again, that's going to impact your EBITDA. It's going to increase your EBITDA, actually. And then unusual income or expense items, such as paycheck protection loans that were issued in the past, employee retention credit monies, things that are unusual income or expense matters, again, are going to be items that will going to be part of the normalized adjustments or a normalization process, and then would be under scrutiny or under review as part of the quality of earnings process.
Yeah, non-recurring litigation that's not expected to happen.
Yep.
One-time sale of assets that you have that is not expected to incur in the future. You might have a physical flood damage, things like that to a plant that's not expected to happen again, non-recurring.
Yep.
Other things would be, salary. If you're the owner of a business, you might be able to pay yourself, twice as much as you would for the same person to fulfill your role, and you're the owner, you can do what you want, but that would be an adjustment back to income because to hire your replacement will cost less.
Right. On to the next slide here. It's just a normalized, just again, continuing on here from a revenue and other business streams, discontinued operations would clearly be something that would be reviewed under a QofE. Startup business operations, revenue expense, and startup business operations is something that would be looked at from the perspective of not only what were the startup costs, but what is the projected cash flow going into the future. So that is something that would be important to be reviewed under a quality of earnings. And then you want to exclude revenue, cash flows, and other business entities from the deal. So obviously, if there's excluded entities or excluded revenue streams and cash flow streams, we would want to identify what they are, exclude them from the deal price, and also from the quality of earnings review for cash flow purposes.
Yeah. Now, here's something that you go back to. If you have an audit performed on your financial information, they should have reliable related party information disclosures. Now, if you have a building and you pay rent to a related party's separate entity, that rent may or may not be at market value. So another adjustment that you would need to consider going forward is, if the rent is going to be different going forward than it is in the past, that's another adjustment.
Yep. Let's talk about balance sheet matters real quick, because we're coming up on our time here to get done. I've just got the notice in capital letters from one of our people here that we're 8 minutes left. So let's just knock this out real quick. But balance sheet matters that we want to review real quick too would be any assets that are driving cash flow and driving the income stream. We would obviously be under review as well on a quality of earnings. Assets that are going to be part of the deal. Think about, are they working assets, and are those working assets driving cash flow and driving capital to the business? We would want to review all those assets as well. And then a lot of times you see in a letter of intent and a purchase agreement, it's going to be working capital. Looking at the working capital from the perspective of what is the agreed upon working capital that needs to be maintained in the business, what's needed to fund operations, and the impact to pay back the cash flow. So again, there are items that, while not part of what we would say the earnings, EBITDA or net income, still items on the balance sheet that need to be reviewed as part of a quality of earnings that drive cash flow and drive the income stream. And then the last couple things that we look at too are taxes. Clearly, if depending on the structure of the deal, if tax considerations are important, you want to look at any notices that might be out there, any carryover credits, anything that might be a hidden gem. We'll call it a hidden gem for somebody. from a tax perspective that you want to take a look at and make sure that you try to uncover those rocks as best you can. And then any other third parties, banks and financial institutions, legal and previous accountant inquiries, talk to those organizations, talk to them in regards to the quality of the management, the quality of the organization, the quality of the information that they're getting that help them, that they're utilizing to make decisions internally. That will help you with better assessing what the quality of that organization is and the quality of that income stream is that you're getting.
Yep.
So with that said, let's go to this last polling question. If your business is looking to buy or sell, will you? And let's let everybody take a minute to answer that last polling question as we are up on our time here. And Eric, anything else you want to add there from the perspective of additional polling questions?
Oh, I do have one final one. And this is a quote. Who said, "It's a dog-eat-dog world, Sammy, and I'm wearing milk bone underwear"? Was it Mr. Rogers, Norman Peterson, or Magnum PI?
That's a good one there. That is good. Clearly, I'm going to go with Norm Peterson on that one for sure.
Absolutely.
Yeah, absolutely.
Absolutely.
So, I can't see Magnum PI making that statement.
No.
So.
No, nor can I consider Mr. Rogers ever talking about underwear. But.
Yeah, exactly. All right, I think we're close to closing this last polling question. So it looks like a good cross sample stuff. Considered an outside advisor to assist the QofE, 28%. Performing internally, 11. Do not see a need to perform right now, 8. And then 53%, we are not active in the market right now. Okay, sounds good. So let's just go and wrap this thing up. I think we're here. So here's our contact information. I am the person on the left, Eric's on the right. Our contact information, our email addresses, and our phone numbers are there. We're happy to answer any questions at any time that anybody might have.
And we will point out one thing on the next slide, Dave. Yeah, we have.
So in closing, well, thank you for joining us today. For the webinar, if you have any further questions regarding today's presentation, please feel free to reach out to one of us. Happy to answer and assist. Keep in mind, a recording of today's presentation will be posted on our website and social media sites in the next few days. And for those of you requesting CPE, which a lot of you are, and answered all the polling questions, keep that in mind. Those certificates will be sent out in the next 2 weeks. So the last slide here we have is just to kind of announce our Collaborate conference that's coming up. Make sure you save the date for this upcoming annual leadership conference, Collaborate. It features a former Penn State football captain and human resource executive, Lee Rubin. So I don't know if there's a lot of Penn Staters out there, but I think you might remember Lee Rubin from some of his late 80s, early 90s teams of Penn State, as well as the noted economist, Arabon Basul. And Arabon is, if you've ever gone to Associated Builders and Contractors events when they do their economic forecast, he is the speaker. Very lively, very entertaining guy. Takes a subject topic that might be dry and makes it kind of interesting to listen to. So, hopefully we can see you there. It's an all-day conference. It's going to be on Thursday, May 18th at the Penn Harris Hotel here in Camp Hill. So if you want to go, please visit our website to learn more about it.
Please
With
do.
that being said, I think we can go ahead and sign off. I want to again thank everybody. Have a good day.
Thank you very much. Everyone have a great day.